Hey, Jerry, it's 9 o'clock, and I do see Kathy and Franklin.
Yeah, yep, we're good. Okay, well, I will call the meeting to order. Dawn, if you would be so kind as to do roll call.
Of course. I do want to remind everyone that we are live streaming and recording this meeting, and both of those processes have already started. Additionally, if any board members attending virtually need to leave the meeting at any time, please post in the chat or otherwise let me know, uh, as we may be taking votes without a roll call, and we need to comply with statutory requirements regarding the virtual public hearings. Jerry Abrahams,
Here.
Phil DeFronzo, Zani Imatowski, Catherine McKinnon,
Here.
Commissioner Perez, Franklin Perry,
Here.
Kim Moores.
Here.
We do have a quorum in attendance for this meeting.
Barely. But thank you, everyone. All right. I guess, Nick, you're first on the agenda for the 2026 pricing report.
Yeah. Yeah, so Jerry, and for the benefit of committee members, we do have two representatives from Wells Fargo, Nick Fleur and Rebecca Reed, to discuss and provide an overview about the pricing and the closing of the 2026 Series C single-family bonds. So it was a very exciting pricing, I would say. Doing it right after Memorial Day holiday, that we got it done. So thank you.
Thank you very much.
I would add to that. I don't want to steal your thunder, Nick, but I'd also argue that very successful pricing.
Yeah, no, well, appreciate that. It obviously has been an interesting year in the muni markets. I mean, we've seen very robust issuance in the housing sector year to date. That's all against a backdrop, though, as we well know, of very high oil prices, a lot of volatility in the world markets. The week before, we did hit a sort of year-to-date high in the treasury markets before there was some optimism that the Iran and conflict would be resolved, which provided some good wind to the sails. But if you look at the PDF that I think we circulated the book on page 6, just some of the transaction highlights starting over on the left-hand side. This was a fairly large issue, 382 million total of bonds. Of that, 288 were long-term fixed rate bonds consisting of, as you can see on the left-hand side, 20 million of non-AMT. So that was just the tax exempt portion, with the balance 268 of being taxable bonds. We also offered the largest PAC bond, which again is a targeted redemption bond, 110 million. That taxable PAC was the largest PAC bond that has been sold in the market year to date.
Hey, Nick, when you target the amortization, and forgive my ignorance on how these PAC bonds work, but when you target the amortization on the PAC bond, where doesn't somewhere else on the structure then have to absorb the prepayment volatility? And does that go to the VRDOs, or see what I'm saying? In other words, if you have prepayment that falls outside your PAC bond target, where in the structure is that absorbed?
Yeah, well, that's a very good question, and it does so basically you can see on the third bullet there, this PAC bond was structured from 75 to 500 PSA. So in other words, prepayments up to, let's just say, 75% of expected experience would go to that PAC bond. So they wouldn't hit any of the other bonds until you reach that 75% level. After that 75% level, you're right, it would target the other bonds, generally the serial bonds, the term bonds, the other bonds in the structure. And as a consequence, and as Rebecca will talk about, I think these PAC bonds have been seen by the market. We've seen spreads come ever tighter over time. And I've thought this for a long time, and that, with a sort of fairly certain 5-year average life, I mean, you're picking up, this PAC bond was traded at plus 80 to MMV. So, that's 80 basis points spread over what a, say, Connecticut GO bond would be, which would trade at MMD flat. So if you're an investor, you're picking up, a lot of yield with a relatively strong certainty of average life. With albeit, there are obviously you can have changes in prepayments and you could have extension and so forth, but they have proved very popular. Does that address your question, Jerry?
Yes, thank you.
Awesome. So just back to the market, which is the kind of second block of text on page 6 there. As I mentioned, we did kind of have year-to-date highs in the Treasury market before we had some progress in the U.S.-Iran negotiations that happened over the weekend. As a consequence, we had winded our sails, as I said, with Treasuries rallying when we came in. Again, it was a 3-day weekend, as Azim said. We did get out a pre-marketing scale before the weekend. But on the non-AMT, again, with a very small portion of bonds, $20 million being offered, we had very solid demand there with 33 million of orders. I would say that the earlier maturities were more robustly subscribed than the intermediate ones. And then on the taxable bonds, you can see that we had very good subscription with kind of 1.7 times subscribed. If you just flip over to the next section, in terms of page 7, that gives you an idea of the structure. The variable rate bonds that we marketed right before pricing were done as daily VRDOs, meaning they were variable rate bonds, and that was $92 million of the sale. Just lastly, on page 9, it's the usual group that we have on the underwriting side, with a robust selling group as well to kind of help market the bonds. So with that, maybe I'll turn it to Rebecca if I haven't covered everything in your section already.
Okay. That's all right. No, Nick laid the groundwork very well for the market backdrop. Clearly, the focus of the market over the last few months has been the Iran conflict with the U.S. We've seen, obviously, volatility be very high, as you can see from the bottom middle chart there, with volatility kind of spiking up to 78. This is also, we've seen an impact on crude oil prices and also CPI and PPI relative because of the oil impacts. When we were in the market, we were looking at oil prices of about $103 a barrel. These charts were as of our pricing, and obviously things have really retreated back over the last.
Lorraine, can you move to page 11?
Oh, thank you.
Yeah, okay.
Great,
Yep.
Thanks so much. Clearly, we've seen an improvement since when we were in the market. As everyone is probably well aware, there's been a recent preliminary agreement with Iran, and we've seen some improvement in terms of the strait reopening for ships. So we have seen a decline in oil prices, as I mentioned. Inflation has ticked back down a little bit as well. But one of the other things I wanted to mention is just where ratios have been between MMD and U.S. Treasuries. The bottom left chart here, as you can see, since CHFA was in the market back in March, we've seen those ratios between tax exempt and taxable come down, which is actually beneficial to CHFA, meaning tax exempt rates are lower relative to Treasury rates. So that's been positive for issuers. And then turning the page, this is if you take a look at the heat map on the far right, this is a daily graphic of the movements in MMD, which is your second to right column, as well as U.S. Treasuries, which is the far right. And where you see the red coloring indicates where interest rates were rising, and green is where interest rates were declining. So it really shows you kind of visually what interest rates were doing in the days leading up to our pricing. As you can see, we saw more of a challenging rate backdrop in the Treasury market, as indicated by more red on the top of the chart up there, and then a little bit better of a situation on the tax-exempt MMD rates. But as Nick had mentioned, we had seen the week before a challenging U.S. Treasury environment, and then we did see those rates come down the week that we priced. And if we had laid on the next 5 days or so of movements when we were in the market, you would have seen that we were in a green environment where rates were coming down. So that was a really nice backdrop. We had more stability there. Bottom left on the page here, you can see the MMD yield curve progression since CHFA was in the market back in March. And rates were definitely 20 basis points higher on the long end and as much as almost 50 basis points higher on the front end of the market there. Just turning briefly to slide 13. In terms of municipal issuance, we are kind of on track for where we were last year with 230 billion of issuance year to date. We're now up to just about 300 billion of issuance. But more importantly, on the bottom right, this is the weekly municipal bond fund inflows and outflows. As you can see, the blue positive bar chart on the right is just demonstrated the fact that we had kind of weekly strong inflows into municipal bond fund flows. This follows, so year to date, we're at 38 billion of positive money coming into the municipal market, following a year of 40 billion of issuance for the whole year. So this year is very strong in terms of inflows. And then turning finally to page 14, in terms of what we saw in the market, this page here on the sort of primary part of the page, this shows the other municipal clients that were scheduled to price the week that we were in the market. It actually turned out to be a really great week to price. As we all know, we priced the week just following Memorial Day, and because of that, the issuance was very light. So for the whole week, we priced approximately 7 billion of issuance, and this is far well below the average weekly issuance amount of about 12 billion. So there was a lot of focus on our issue because of the less, competing supply. Away from our deal, which was the second largest housing bond of the week, Pennsylvania had a single family pricing and also in the market, 330 million. And then there is a small Oregon housing single family transaction of about 50 million. HFA, New York State HFA was in the market with a transaction of about 90 million. And then there was a handful of other smaller multifamily issuances in the market. But just in terms of economic data, really nothing terribly market moving. You can see on Tuesday and Wednesday when we were in the market, just had a few economic indicators come out, but nothing that really moved the market substantially. Would pause to see if there are any questions on the market backdrop before I pass it over to Nick.
Good. All right. Well, just as Rebecca said, there were a number of other HFA deals that were in the market that same week. And if you flip to page 16, I think that the relevant stats that we have boxed out there kind of show the spreads to MMD for some of the comparable transactions that were in the market. In general, as Rebecca said, Oregon, both and New Hampshire, both quite a bit smaller. The size of the maturities are listed there. You can see that Connecticut's maturities were a little more robust in terms of size, sometimes many-fold. But you can see, relative to, say, in 27, the second half, where we were 16 spread, Oregon was at 26, so 10 basis points wide to us. And New Hampshire, even if you look across in, say, 29, where they were 49 spread, we were at 39 spread. So I think favorable comparisons on the spread side. As I mentioned at the first part, though, the bulk of our debt was in the taxable maturities, which you flip over to the next page, you can see that while there weren't a lot of other comparable large taxable deals in the market the week we were there, I would say in general, the taxable municipal market has proved to be very kind of a bright spot for housing. I think that investors are seeing housing bonds as again a good alternative to treasury bonds. You have obviously very favorable ratings, and so we've been able to enjoy very robust spread. Additionally, here we had what we call a reverse inquiry from an investor where some of the intermediate serials, if you will, were not fully subscribed for. We had an investor, the Federal Home Loan Bank, that came in and said, look, we would be very interested in buying those bonds to the extent you could lock them out from prepayments. And while I would say, Hazim is not a big fan of lockouts, as per your question, Jerry, because a lot of those prepayments are being targeted to the PAC bond, especially with the serial bonds, where it's almost like a free option in that, those prepayments are going to be going to the PAC bond anyway. So locking out the serial bonds was almost, we could do that, and providing we got paid for it, and roughly, let's just say it was a 30 basis points reduction in yield versus sort of callable serial bonds. So we decided to move forward with that lockout. You can see that's the bond that's basically 21,700,000. And that spread was, quite a bit through where the callable bonds were. So that was a very favorable result. And you can see that, relative to, say, the other deals in the market, even though we had, pretty much larger size blocks, we did compare favorably. I know that, one of the questions that CHFA likes to focus on is just how you've done historically versus, prior deals. And maybe Rebecca on page 18, I think
Sure.
that's kind of an interesting comparison.
Yeah, so on page 18 here, you can see the average for 2024, which is the very top line, versus 2025, which is the green hashed line. And then in the 2026 year-to-date average is the bottom line, which is the blue line. So the bottom line includes our transaction, the 2026 Series C, as well as the earlier issuance from the year. But you can see just how much tax-exempt spreads have come in over each of the last 2 years. So in the especially at the long end, you see the most differential between 2024, 2025, and 2026 year-to-date. So we're looking at essentially 60 basis point improvement in spreads on the non-AMT debt. If you turn to the following page on page 19, we see a similar trend, although a little bit, you don't see as much of an improvement as we did on the tax exempt side, but still taxable spreads have come down. You can see the bottom line, the blue. It's a little bit more noisy because I think there's only a couple of data points we had for the 2015 maturity. The first deal of the year was spread to US Treasury plus 126 versus the transaction we just sold was spread at plus 110. So the average is a little bit, it's not a smooth line as you see in the other years, but again, it's only a couple of data points there. But the reason also I wanted to point out that we don't have a lot of information on the long-term debt on the taxable side is because we did have a taxable PAC in our structure, which replaces the back end of the structure. And these two charts that I just went through, these are really indicative of the serial bonds as well as the term bonds, but do not include PAC spreads. Any questions on the trends in spreads? All right, and I think I'll pass it back to you, Nick.
Yeah, so just, quickly on the progression, again, we had a favorable market backdrop. So as you can see on page 20 here, we were able to both change interest rates between the retail order period and the institutional order period by 5 basis points on the tax exempt bonds. And then after we had the institutional order period, you can see that in general, we were able to adjust the scale another 5 basis points for an aggregate of, 10 basis points improvement. Obviously, always good when you can be moving yields lower versus higher. That was echoed, maybe not to the same extent. As I said, in the taxable bonds, we did have the home loan bank come in to clean up a lot of the unsubscribed maturities on the taxable side. But we did have, we were able to make price adjustments, as you can see on page 21 here, at the front end in the 28 maturity, as well as some of the maturities at the longer end. We were able to tighten yields there. And that was really a basis of subscription, which those are shown on pages 22 and 23. You can see that obviously we had, very robust subscription at the front end. Green is basically national retail versus the blue is Connecticut retail. So we had, enjoyed very good subscription from Connecticut retail. Obviously, again, only $20 million of these tax exempt bonds. And as Rebecca pointed out, the one thing I think that we've seen is that those spreads have gotten so tight that we're, to a certain extent, retail is, seeing them as not terribly appealing because they have those spreads, which is great for CHFA, not so great for the retail investors. And then on the next page, again, on 23, we list the kind of subscriptions on the taxable side. And those blocks, as you can see in the middle there, that was largely where the home loan bank came in, where we didn't have, those oversubscriptions. So again, great result. I think it was great to have the home loan bank come in. We enjoyed, even though we had a very strong or high percentage of taxable in this series, great result. And, on behalf of Wells Fargo, certainly appreciate the mandate and vote of confidence. And Breck and I are certainly happy to answer any other questions that we didn't cover. Okay, thank you.
Jerry, you good?
Any questions from anyone? No. Thanks, Nick. Thanks, Rebecca. It looks like really good. I find the spread trends very encouraging. So as even just something we can keep at. I guess the only other question I guess I have for you, Nick, and I know this is a question that is, is kind of tough to answer, but like, how much does our AAA really help us, you think, in the market these days? I mean, just looking at where, I mean, it's hard to get an apples to apples comparison on your price comps, but like, really, how, I mean, and Connecticut, I know it's got a great name, but is our AAA really versus some of the other clients that are in the AA1 category? Are we really seeing a huge pricing differential spread between those consistently from transaction to transaction, or is the market all kind of like look at all that sort of the good quality single family housing programs and kind of lumps them all the same and looks at other kind of factors?
I'd say it's probably more the latter, Jerry. I'd like to say that, AAA, I mean, AAA is definitely fantastic from a retail marketing perspective, and, but I think on the institutional side, which is, where the bulk of the buyers are, these guys are doing their own diligence on these programs. And a lot of times you'll see the differentiations that are made is very nuanced. I mean, Illinois, for example, we're bringing an IDA issue this coming week after, again, a long holiday weekend. So that'll be interesting. But, IDA typically, unfortunately, given the nature of the state and their finances, they'll often be penalized, they call it the Illinois penalty, so to speak. Again, states that have a lot of debt issued where there are other alternatives. Sometimes you'll see, New York HFA, New York City HDC, who bring a ton of debt. Honestly, they're kind of seeing a little bit of investor resistance in that a lot of the portfolios are full, even though they're highly rated, that the programs have robust fund balances. I mean, there's no really credit negative other than the fact that
Concentration, yeah,
bonds outstanding. So I mean, it's definitely a plus being AAA, but I would say that in general, folks, investors, because they are looking at high AA, if not AAA, amongst all of your peer group, they're making more nuanced kind of state by state decisions. I don't know if
thank you.
you have any other thoughts.
No, I mean, I think it's clearly positive that you have the AAA, that you have the moral obligation backdrop. You've got really strong retail, and that sets you up really well going into the institutional pricing. Having that strong retail success allows you to be more aggressive on the institutional side. So all positive factors, but yeah, I mean, I think Nick brought up some good points about, I think, people kind of issuers being a little bit in the same kind of category. But, on the PAC side, investors are really scrutinizing like redemption history. Have you been meeting your PAC tables? And so all of that is very positive from your perspective as well. So definitely many strong things helping out your transactions.
I mean, you probably know this, but you are definitely top tier HFA from an investor standpoint. I mean, there's you run that balance of great ratings, great management, strong retail, and kind of good investor outreach. So
Excellent. Thank you, guys.
you
Hazim?
Yeah. Okay, then go to the next item. I have nothing to add.
Well, no, I was, yeah, next item. financial reports.
Okay.
Good morning. Before you are the May financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 2.9 million over budget for the first 5 months of the year and 22.4 million higher than last year. The increase in the authority's investment portfolio is the large driver over the year of the year-over-year variance, as the portfolio is a little bit $1 billion higher over the same time last year. On the expense side, interest expense is 7.8 million below budget through May and is 19.4 million higher than last year. Driving the prior year variance is again a $1 billion increase in outstanding bonds from this same time last year. Administrative expenses are coming in 2.7 million below budget and 1.4 million higher than last year. When you exclude salaries and benefits of 12.9 million, the current year expenses are 884,000 higher than last year. And then lastly, the change in net position is above target by 15.3 million. Are there any questions?
Sure. Seems to be consistent with our results. Thank you, Allison. John, production delinquency. I'm sorry, any questions for Allison? Board members? Okay, John.
Good morning.
Production delinquency reports.
For the month of May, the authority purchased 365 loans totaling $105 million. The total production for the first 5 months of 2026 is $33 million ahead of 2025 and $28 million ahead of 2024. The 97% of May's production was securitized, leaving 12 loans totaling $3.9 million as whole loans. Our May month-end mortgage-backed security portfolio balance was $4.6 billion, which is $78 million increase over April, while the whole loan portfolio through April declined by $3.9 million, remaining at approximately $1 billion. The whole loan delinquency rate declined 44 basis points to 6.3%, which still remains less than the state nationwide averages, and our carrying balance of loans and foreclosures year over year is relatively unchanged at approximately 100 loans with a balance of about $11 million. The authority also funded 65 down payment assistance loans in May for $800,000 and 161 time to own forgivable loans at $3.7 million. For our multi-family portfolio, there were 3 new loan closings in May, increasing the portfolio by a net of 1 to 596 loans totaling $1.7 billion. There were 5 permanent loan delinquencies with a delinquency greater than 60 days, and the overall delinquency rate for the multifamily portfolio was 0.25%. Any questions?
Yep, hearing none. Joyce, internal audit.
Good morning. I'm here this morning to talk you through the first half of the audit activity of this year. Also included in your package is the updated audit plan. We have made a few changes and I will walk you through those as well. Starting with CHFA audits, we completed an audit of the homeowner mortgage loan delinquency and foreclosure monitoring process. The process is performed by or outsourced to our loan servicers, but in finance portfolio management, they perform an oversight and they follow up with the servicers at various points in time. At year end 2025, there are 333 first mortgage loans totaling about $41 million that were 90 days or more delinquent. We completed this audit mainly for 2 reasons. The first was there was a new system implemented and there were enhanced processes, monitoring and follow-up processes implemented as well. The second reason, as discussed at recent board meetings, is that there is the potential for increased delinquencies due to changes in loss mitigation options. Our audit results concluded that internal controls provided satisfactory assurance that risks were being effectively managed in relation to the objectives we outlined in the report. A recommendation was made to correct system processing so that delinquent loans were classified in the correct status and also included on all of the monitoring reports for follow-up. This recommendation is being actively addressed. The detailed audit report for this review is attached to your package. Turning now to servicer compliance reviews. We perform reviews of the homeowner mortgage loan servicing and collection functions performed by the loan servicers. In accordance with the 2026 audit plan, we completed a review of Mule Mortgage, which is the authority's loan subservicer. They service about 1,900 homeowner first mortgage loans with an approximate balance of 155 million, which is about 15% of the whole loan portfolio. We issued a review letter and we reviewed the subservicer's draft management response. And this review is pending additional updates, which we anticipate having by the end of the week. We completed a review of Chelsea Groton Bank, which is services a very small portfolio for the authority's first mortgage loans. We issued a review letter and reviewed the servicer's management response. Based on discussions with finance portfolio management, we do not anticipate performing planned servicer reviews for M&T Bank and Bank of America, as these servicers have requested that the loan portfolios be transferred. These are smaller portfolios, just as a frame of reference. This is pending the execution of the termination and transfer agreements. Moving on to advisory services. So from time to time, we will do, to help the authority, we will perform advisory services. These are limited in scope and not traditional audits. So as Anthony mentioned at the last board meeting, we were asked and have completed a review of the 2026 allocation of federal 9% low-income housing tax credits. Based on the review of the process and the documentation used to allocate tax credits, we had concluded that the rating and ranking of applications was performed in accordance with the LIHTC 2026 QAP. And then further, based on our audit sampling, our tests were concluded that the ranked applications met threshold requirements and no point errors were identified which impacted the ranking of applications. A detailed memo.
I'm sorry, Joyce, hold on 1 second. Commissioner Perez, did you have a question?
Yes, I do, but I could wait for her to finish.
Oh,
Okay. Good.
I didn't want to interrupt her, but I wanted to make sure.
2 more minutes. Yeah. Okay. So a memo's
Sorry,
attached
Joyce.
to all our audit objectives, and it's in the back of the packet. And also in terms of advisory services, we continue to monitor the implementation of IT security controls regarding cybersecurity risks. The team is in the process of creating process documents, and we are reviewing them as they become available. It is based on the Center for Internet Security, and there are 18 controls or best practices that they have encouraged organizations to implement. We have reviewed 5 process documents in 2025. We've reviewed an additional 4 documents this year, including inventory and control of enterprise assets. We are specifically looking for alignment with the CIS detailed controls. They are basically called baseline safeguards. We are also working on a project to specifically document the security controls in place at this time, and I will report back to you on those controls later in the year. We continue to participate on authority-wide committees. During the period, the Employee Recognition Program Committee concluded their review and recommended solutions to improve the program. And lastly, at Anthony's request, we participated on an appeal committee with finance, portfolio management, and legal to review an EMAP application. This project was an addition to the audit plan and has been completed. With that, I'd be happy to answer any questions. Commissioner Press?
I have 2 questions. One, you mentioned that we didn't do the analysis or the audit on M&T Bank and Bank of America because they asked to transfer the portfolio. So my question is there any particular reason why they asked for that transfer? Are they getting out of the business or were there any issues?
This is the
Yeah,
question about Bank of
M&T.
America.
And
Yeah.
M&T,
Yeah.
their
Yeah,
request is
it's Bank of America, back when I joined 12 years ago, had an outstanding request to transition their portfolio. At the time, they're trying to reduce the amount of loan servicing. As you might recall, they were trying to get out loans for me as much as they could. It's been very frustrating for me because I've been trying to move that portfolio to a small portfolio where we are trying to reduce the number of servicing portfolios we have that we're reconciling monthly. I think I finally reached somebody that is now beginning to cooperate and move the portfolio, but again, it's relatively small. M&T also expressed an interest, and it's the same thing. It's fairly small portfolio, and we're actually happy that both of them are interested in moving them just to again consolidate our portfolio.
Well, that's interesting information, but that isn't my question. My question is there any reason why they want to transfer the portfolio? I mean, are they getting out of the business? Which I know Bank of America has been trying to do that for a while, but versus that we're happy that they're doing it because it's smaller and it's easier for us to reconcile.
Yeah, I think we do have some fairly rigorous requirements that we require from them monthly. And it doesn't necessarily, I think, flow with the way they handle some things. So they have to have an exception in their process for servicing our loans. It does take a training when staff turns over. When they do, we reconcile their portfolios monthly. We send a list of where each reconciling item, and we follow up monthly to have those reconciled. I'm sure they find that inconvenient. And I think honestly, I think it might be a corporate strategic focus matter as well as to have a portfolio that is not assets they owned, and they're doing third-party servicing. I think that's something that is probably one of the driving force behind their interest in moving the portfolio.
Well, I want to commend you guys for balancing on a monthly basis because that's best practice. And that's very important because if you don't do that, it may take a while to catch something that went wrong. So I go to my second question now. On the cybersecurity, Sam, so when we look at cybersecurity, are we starting looking to see about the usage of AI?
Is the business unit looking for?
You said part of the examination or the audit was looking at the cybersecurity and the internal controls over IT, right?
Yes.
So my question is, considering a lot of these entities are now using AI, and there's been a couple of case studies where AI could go really haywire if you don't watch it. My question is, have we looked at their AI usage when it comes to their mortgage products? Or are we considering doing that in the future examinations?
I guess we could consider that in the future examinations. I don't think we're really looking at usage of AI.
Yeah. I think it may make sense because, for instance, there was the case of Apple where they were using AI to do credit card issuing. And then when the regulators came in, they found out that females were getting declined a much higher percentage than males, even though the credit was as good or better, and their income and the debt service was as good as better. And there were some flaws in the thinking of AI, and I know they're not making credit decisions, but they're making other decisions. So all I'm saying is it may make sense for us to start thinking about.
With the loan servicers, we do a internal control questionnaire with each engagement. I think that would be a good idea to potentially add that question to that.
That's all.
And then see what we get for results.
Well, I think there's two aspects. Is what the commissioner says too is AI for loan servicers or other vendors. They're using AI, and what are the implications of that? Either way, we use AI and Zoom to summarize meeting notes, all that kind of stuff. But there's a separate issue with respect to information security, and that we are likely to become, we're targets now of numerous attacks, and those attacks are likely to get much more sophisticated as nefarious actors use AI and attacks on us. And we should probably, for our Joyce, for the next report, look at specific I know it's part of our our informational security apparatus that we're looking at this. I'm sure it is because our vendors are doing it, but we should probably maybe focus on that as well.
Will do.
I mean, and to the point you were making, the chair was making, a lot of entities are using AI to help them stop fraud too. So that's why it's
Yeah.
important for us to get an understanding of how they're using it. And, maybe not necessarily today, maybe not necessarily tomorrow, but in the very near future, as more and more of them start using it, and the people who want to do back ends learn how to use it too, it'd be good for us to have an understanding. That's the future.
Well, yeah, I mean, actually, if you think about it, this is even a bigger issue, right? It's not just
Yeah.
cybersecurity or asset or asset management practices, but as an organization, it's probably beyond the scope of this committee. But we're going to need AI policies, right? We're going to how we're going to employ AI. We're using AI. How's it affecting us from across probably the whole organization? And it's probably going to be something that we need to start confronting in a lot of things.
Jerry, we do have an AI policy. So we do require employees to get permission and approval from the IT department regarding their use of AI. And for the most part, we're looking at generative AI. So for, memos and things of that nature. No one's using, predictive AI models. And if there is any sort of use of ChatGPT, for example, it's done through an internally hosted, secure version.
Thanks, Danny. I guess the question becomes, I mean, and that's helpful, but the question becomes, are we thinking about, again, I think it's beyond the scope of this committee, it's really more for the full board. So let's not get too bogged down on it, but it's probably going to need to be bigger than that at some point. But again, I'm not sure that's really an audit committee issue. All right. So,
Understood.
all right. Thank you, Joyce. Any more questions for Joyce? Okay.
Yes.
The minutes.
Yeah, just a comment
Sorry,
on the AI.
Catherine.
I was at a NeighborWorks training last week and given by a person from it's called the Kendall Project. And this group is in Cambridge and they're working, putting together cohorts of nonprofits to figure out ways to improve efficiency and use AI effectively. And I thought it was a fabulous presentation. So, if CHFA is interested in that, I can forward the contact information for them just to talk to them. I thought it was really, really interesting.
Absolutely. Thanks, Kathy. We're excited about the use of AI, right, in business. I don't want to sound like we're alarmed. I think that we just want to make sure that we understand how others we work with are using it and that we have the proper controls. So we're all
Yeah.
in favor of expanding our understanding. So absolutely.
Commissioner Perez?
I just want to ask Kathy if she could send that to me too. I appreciate it. And I also want to go on record that I support us using AI. And I think AI is not a bad thing. In fact, in my agency, we're working with the governor's fellows to develop a couple of usage using AI, like reading minutes when we go out and do examinations and helping us put together our examination plan. However, having said that, it is a new tool. It's still learning, and we got to be careful that it doesn't have some unintended consequences, like in some case studies that have come up. That's all. But I'm a total supporter and advocate of using AI when appropriate. And then we also got to keep in mind that some of our customers, right, clients, may not be as sophisticated as others, and we still need to service them. And I don't mean us directly, but through our vendors.
Catherine, I'd like to see that report.
Yeah.
You may remember just send it. If you don't mind sending
Yeah,
it
I'll
to the
send it
whole
to
audit
everybody.
committee,
Sure.
wonderful. Thank you. Okay. I guess we go to the minutes. Any comments or questions on the minutes? Okay, hearing none. Rob, do I take a vote on the minutes? I forget.
Yes, just a motion,
Okay.
a second, and then a unanimous consent.
Okay, so can I get a motion to approve the minutes from the April meeting?
So moved.
Second,
Second.
Ms. Franklin. Okay, all those in favor say aye.
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 All those opposed? Any abstentions?
Mr. Chair, I think I'd like to abstain as I was not in attendance at that meeting.
That's fine. One abstention. Although, Rob, I don't think that isn't an absence, not, you don't need to abstain for an absence.
Well, we've been following the practice that we'll run a roll call just to confirm since we have an abstention. So Dawn, could you just run a quick roll call?
If you need me to vote in favor, I'm not sure it's a
No,
problem, but
no, we expressly are just going to do a roll call to confirm the abstention. That's
I
all.
see. Okay.
Because everyone's virtual. That's all.
Very good. Jerry
All right.
Abrahams,
Aye.
Phil DeFranco. Phil, I see you there. I'll come back. Zani Imitowski, Catherine McKinnon,
Aye.
Commissioner Perez,
Yes.
Franklin Perry,
Yes.
Kim Moores.
Abstain.
Thank you. Phil, can you hear me now? Okay, the motion passes.
Thanks, Dawn.
Thank you.
Thanks, Jerry.
Thank you. Okay, anything else, Hazim or Nandini, that you would like to bring in front of the committee?
Not at this time.
Yeah, nothing from me.
Okay, any audit board members have anything they'd like to bring up to the committee? Okay, excellent. Hearing none, then again, thanks to Wells Fargo's folks for the presentation. And I need, I guess, a motion to adjourn. The chair will make a motion to adjourn. Can I get a second?
Second.
Second.
All right, all's in favor? Aye.
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 Any noes? Any abstentions? Great. All right, see you guys in a bit. Thank you.
You.